welcome to this week's MFB News. Hope everybody is well, having a really fabulous time in this glorious weather. Certainly it'll be helpful for those of you with little people off school. And I do hope actually some of you have been able to get away at Easter. You can see that I obviously haven't, but I won't draw on that too much. Now, in terms of what we've got for you this week, I think what I would say is that it never rains, but it pours. We're going to be looking at how the Trump tariffs are impacting UK mortgage pricing, and it is having an impact. So we'll dig into that in a bit more detail. Obviously that's going to loop into swap rates quite nicely, and I'm going to run through the lender pricing changes that we've seen in the last week. We're then going to have a quick run through on some housing market data in terms of the sales market, so you can see what's going on there. Always quite useful for those of you who are thinking about buying properties but also selling. There's a lot of landlords who are kind of mulling over selling properties as well at this moment, so always quite interesting to see how likely is your property is going to sell apace. And then finally, as an absolute bonus feature this week, we're going to be talking a bit about making tax digital, because that is now 1 year away for some of you, not all of you, but it really is time to start preparing yourself if you haven't already. Okay, now, unless you live on Mars, and perhaps the tariffs have been extended to Mars as well, who knows, more than likely, you can't have escaped the fact or the news that Donald Trump has now imposed his raft of tariffs against many countries, which essentially means that goods imported into the US from those countries will be subject to a tariff, which means that the price of them in the US will increase, which is really kind of driven, I suppose, to kind of stop people in the US buying these goods, but actually sort of seeking products which are produced either from different countries or internally to sort of drive up the US economy. Now, the UK is facing a 10% tariff on all exports to the US. So essentially anything that people in the US buy from the UK just went up by 10% overnight, basically. There's also a 25% tariff, or global tariff, should I say, on all cars. So every single car, no matter where it's produced, that's imported to the US will be going up by 25%. So you can kind of see what's going on here. Now, the expected impact of these global tariffs is going to be really serious. There's no escaping this fact. So terminology, for example, global financial crisis and that kind of stuff are getting bandied around. Now, will it be that bad? Let's just wait and see. Don't want to be too dramatic, but there's no escaping the fact that actually if businesses are finding either greater costs or actually are finding they're not able to sell as much stock to the US because people over there simply aren't buying it because the cost has increased, this is going to really slow down businesses and growth. This then leads to unemployment, and you can see where things kind of go. So it's a really, really bad decision by Donald Trump, particularly for the broader global economy. However, the impact of this in terms of mortgage pricing, and there is a small positive, and I'm not going to make light of the tariffs because they are really serious and the impact is really bad, but the very, very small silver lining of this is because of the expectation of markets slowing down, potentially recessions, all that kind of stuff. This is really kind of readjusted the market's view on what's going to be happening with base rate going forwards. So previously, people were penciling in base rate reductions of between 0.25 and 0.5% for the remainder of this year. Pretty much since the tariffs have come into play, the markets have now said, actually, we think it's going to be 0.75, so 0.75% reduction, so 3 rate reductions basically throughout the course of this year, with the first one coming in as close as May. So what this means is that actually you will know from our many conversations about this, and I know I bang on about this often, mortgage fixed rates are largely influenced by swap rates, and swap rates are largely influenced by the prediction of what's going to happen with base rate going forwards. Because the markets are now thinking that base rate is going to fast forward its decline and also being more steep, this has then meant that swap rates have come down. So if we think back to last week, where we were saying that 2 and 5 year swap rates were sitting at just over 4% and they'd floated back up because they'd been down below that previously. Actually, where they are now is that both 2 and 5 year swap rates are now sitting at just over 3.8%. So essentially, week on week, they're 0.2% lower than they were. So this means that actually, essentially, lenders' cost of funds has gone down by 0.2%, despite what many people think. Lenders are not really awful, money grabbing, institutions. What they do tend to do is pass on these cost savings to their borrowers wherever possible. So this really does open the door for lenders to start making rate reductions of up to 2.2% if you think about it as a kind of theory. Now, will we actually see that, and what's going to happen going forwards? Now, just to say, the swap rate's actually dipped down to below 3.8 from one point in the last couple of days. 5-year swaps were at 3.75, so things are floating around a little bit. So I don't know that your kind of 3.8 is the end result. It might even come down further, and it might float up a bit. So we're just going to have to wait and see. And I think what it's fair to say is that people are very kind of, one thing Donald Trump has certainly done is create a lot of uncertainty, because he's saying on one hand, you know, just to kind of give you the context, I'm going to put these tariffs in place. Then in the next breath, he's saying, but we're open for business, we're open for negotiations. This could all change again. Needless to say, the kind of world has reacted fairly adversely to these tariffs. So again, this all might move on, but where we are as of today, 2 and 5 year swaps have come down by 0.2%. So have we seen a bunch of lenders react to this and drop their rates down by 0.2% in the last couple of days? No. Why is that? Because actually the rates have been bouncing around, as I just mentioned. They're probably going to be looking for things to settle a little bit. And also it takes time for lenders to reprice whole product sets. And I've spoken about this before. It's not a case of them going, oh, rates have come down by 0.2, everything just goes down by 0.2, and bash, it's launched out into the public space. It has to go through a series of treasury, compliance, marketing, technology. You know, it's actually a really big piece. So I think realistically, for those lenders who are going to be able to take on board this lower cost of funds and release new mortgage rates, you will start seeing things start to trickle through in the next few days. Now, have we seen any lenders react already? We've seen a couple of lenders drop their pricing down in the last week. I don't think this is in reaction to what we've seen with swap rates in the last few days necessarily. I think it's too fast. I think this was just lenders repricing. So just to touch on those guys very briefly, because I always like to acknowledge those lenders who have brought their rates down, because it's good for you guys. The mortgage works have dropped some of their rates down by up to 0.1%. We've seen the mortgage lender also make reductions of up to 0.1%. We've seen Keystone bring their rates down by up to 0.15, and we've seen Molo drop their rates by up to 0.3. So I think really the sentiment, I know I say this all the time, but I think it's a bit like watch this space. So obviously this time next week, we'll have a lot more of an understanding of really what's going to be going on, how things are starting to settle down, and also starting to see whether we're going to be experiencing lenders bringing some rates down. So let's keep our fingers crossed for that, and we shall keep you posted. Okay, now a quick view on what's happening in the sale and purchasing of properties. Always quite good just to take stock on what's going there occasionally, particularly if you are thinking about either buying or selling. So we're now into week 12 of 2025. My word, where is it going? And we're starting to see the listings data continue to revert back to kind of like the mean average, essentially. So there was an absolutely massive boom of listings at the start of the year. And the number of listings coming onto the market is slowing down, which means it's dragging the numbers back to an average figure. So just don't forget that 2025 still remains the biggest start to the year for listings in a long, long time, at least a decade. So where are we? So by the end of week 12, there were 435,464 listings, which is 6.66% ahead of the number of listings in 2024. And the second biggest year for listings in recent times. Percentage of stocks, that's being reduced is still sitting at 12%. When we went through these numbers previously, it was at 12, it's still there. The average in 2024 was 12.1%, so we're running a little bit better than 2024. But the 5-year average for reductions is 10.6%. So actually, the number of properties that are having to be reduced to get sold is running a little bit hot. The number of gross sales are just ahead of 2022, which was a very, very busy year for those of you who remember. So actually, the fact we're running ahead of those numbers right now is good, but we do expect that to kind of readjust over the coming months. Don't forget we've had the stamp duty deadline, which has kind of really expedited a load of people buying property. We are also 13.2% ahead of this time last year in terms of the number of gross sales. But again, this is probably going to be largely attributed to the stamp duty. Straplines, 39,700 listings. So new listings of property for sale, that's 7% ahead of the same week in 2024 and 10% higher year to date than the pre-pandemic 2017 to 2019 market. Gross sales agreed is 28,100. That's 13% higher than the 2024 year to date figures and 23% higher than the 17 to 19 levels. So more listings and more sales. Are we going to see that continue? So I do think actually the number of listings, while things are slowing down, that's going to carry on for the time being. I think there's going to be a healthy amount of stock for sale on the market. In terms of the number of purchases, now actually we were thinking that the market might be a little bit kind of challenged once the stamp duty deadline had gone past, which it now has. But actually one of the reasons that people cite for not actually looking to purchase properties has definitely been the affordability issues that come with the higher mortgage costs. So if we do actually start to see rates come down a little bit, that might help kind of keep things ticking over nicely as we move throughout the rest of this year. Now, we are 1 year away from making tax digital coming in for some landlords, so it's time to really start thinking about this and having a look at what you need to be doing. So making tax digital, the first wave comes into play, or the first wave of landlords that have been scooped up, I suppose, into it comes into play in April 2026. The qualifying kind of requirements for those landlords who are going to be in the first wave is that the combined gross revenue that you receive from rent and self-employment is over £50,000. So if you have rent and a PAYE income, that would be something different, but it's if you have self-employed income and rent of over £50,000 in the financial year 24 to 25, you're going to be scooped up into Making Tax Digital's first run out. So what is Making Tax Digital for landlords? Essentially, it's a government digitisation programme that's going to require sole landlords, so not limited companies, this is important, whose qualifying income is over the relevant thresholds to keep digital records of transactions and send quarterly updates to HMRC. So this means that rather than waiting until the 30th of January, like I always do, and then doing a whole tax return whilst running around the house trying to find bits of paper and doing the whole thing in one go, every quarter you're going to be doing a return to HMRC, and then at the end of the year you're going to be doing one final statement to them, which has to be submitted by the 31st of January. Now, the kind of challenges that we're seeing at landlords, I mean, first of all, it's just people see it as a massive faff. Like, you know, I'm the most administratively challenged person when it comes to my own personal affairs. And so the thought of having to do quarterly returns just fills me with horror. Thankfully, I'm not going to be in the first wave, I'll be in the second wave of landlords. But loads of you are going to be just thinking, oh God, you know, this is just another thing to kind of think about. Some of you are super organised and this won't faze you in the slightest, you know, so it's going to be different for everybody. But I think one of the key challenges we're hearing people saying is, you know, the return has to be done on an approved piece of government software. So actually, what software should I be using? Now, what I'm not going to be doing today is recommending a piece of software because I've never used it. But I have seen a lot of landlords saying they're really kind of struggling to find something which is a piece of accounting software which is MTD, Making Tax Digital approved, which also links into their property management software. The one that I've seen some people review and seem to like a lot, and I'm not recommending it, but that people have sort of spoke quite highly of, is something called Hammock. I believe it comes with a 2-month free trial. I'm sure you might have to Google a certain code for this, but that seems to be the one that I've seen that some people like. So Hammock is approved for MTD, and it's been sort of adapted to and customised for landlords. So that seems to be the one which, you know, could be worth having a look at least. I'm not saying to use it. So yes, that's kind of the headlines on Making Tax Digital. Now, are there going to be penalties for non-compliance? The HMRC is introducing a new penalty regime to support Making Tax Digital. It's going to be a points-based submission system for late submissions, where missing a quarterly or annual submission would result in you getting a penalty point. Now, looking at the government website, what it says is that once a points threshold is reached, a financial penalty will be imposed. Additionally, new late payment penalties will be more proportionate, charged at different rates based on when the outstanding amount is paid. So I think it's going to be a kind of, you know, if you were late by 1 day filing your submission, the kind of penalty for doing that is going to be much less severe than if you simply don't bother doing the whole thing for a whole year. Now, in terms of preparation for Making Tax Digital, so the kind of stuff that I'm seeing my clients do, so the first thing is you need to find your software, or find an accountant that can do it for you. And that's going to be my route of going across this. I'm just going to find an accountant who can do the submission. But if you are someone who does your own returns, you're probably going to need to, you are going to need to try and find your software. So that's going to be the first thing. So speaking to an accountant would be a really, really good idea. Now, another thing people are saying is that they're already starting to focus very heavily on digitising all of their records. So what that means is that for those landlords who, and people do actually still use like a ledger book, so they're actually handwriting things down to record all the transactions. Starting to move that across to something like a spreadsheet is going to be really good for you, because it means it's going to avoid a bunch of duplication when you have to start inputting data later on. Definitely worth speaking to letting agents. to make sure that your letting agent can provide you with digital receipts for things. So that will really, really aid your submission speed. Another thing that I've seen some clients mention is separating bank accounts. So I assume that everybody did this, but maybe not necessarily. So having a bank account which is specific to your rental properties, so rents come in, mortgage payments go out, plus any other expenses, so everything is kind of kept in one place. It's very, very easy to have a view on what's been going on. But some people actually still have a kind of current day account, and all their rents are coming in and their mortgages are going out, and their supermarket shopping's on there, and their petrol and all the rest of it. So everything's kind of in one place, and that's going to make it much more challenging for you to kind of break out and be able to digitally submit all of these transactions. So maybe separating your rental business into a different bank account could be really, really useful. Now, in terms of the waves of when things are getting rolled out, so as I mentioned, April next year, where your income was rent and self-employment over £50,000. In 2027, that number is the same kind of metrics, but it drops down to £30,000. And then Rachel Reeves announced that in the spring statement that from the 6th of April 2028, those whose qualifying income is over £20,000 will be included as well. So actually it's starting to really kind of scoop up the vast majority of landlords. Your longest date looks like it's going to be in 3 years' time. Now, actually, what I would just quickly say is that we are hoping to run a webinar on all of this. We're just reaching out to a few accountant contacts to see whether they'll be feeling brave enough to come on camera and have a chat with us about making tax digital, and hopefully we can get a load of really useful information out for you. But in the meantime, just to hope you found that useful and know that it's on the horizon. Whew, there you go, another busy week from us. Now, if you have any questions, you're very welcome to give us a call, 0345 345 6788, and there is always an absolute smorgasbord of information available on our website. We're going to be at the Property Investor Show at the Excel on Friday and Saturday of this week. I'm actually there. I'm going to be speaking as well. So if you are there, please do pop along and say hello. It's always really nice when people come and introduce themselves. We'd love to meet you. Have a fantastic week. Enjoy this glorious weather. And we'll be back same time again next week, hopefully with some news of some mortgage rate reductions for you.